Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important news that move the markets. I'm your host Anurag Bansal, and in today's episode we'll talk about three big stories. In the first story, we'll talk about what is happening in the Japanese markets and what it means for us sitting here in India. In the second story, we'll talk about how the US Fed might be making an emergency rate cut. And in the third and final story for the day, we look at the latest auto sales data for the month of July 2024. So let's begin. See, the markets are a weird place. All that investors and traders want is certainty, but that is the only thing that you cannot get in the stock market. The other thing about most traders and investors is that they expect things to continue. So, when times are good, they think that good times will last forever, and when times are bad, they tend to think that bad times will continue for a long time. Now, things have been really good so far this year. Barring some minor bumps here and there, global markets have steadily gone up, but it looks like trouble may be on the horizon. The markets have started August on a bumpy note. Yesterday, the Nifty 50 in India was down by more than 2.5%. Last week, the US markets were down by 3%, but the real bloodbath was in the Japanese markets. In just the last 5 days, the Nikkei, which is like Nifty for Japan, has gone down by almost 18%. But why are the markets falling all of a sudden, you might be wondering? Well, the most honest answer is nobody knows. See, like I also said earlier, we all hate uncertainty and crave explanations for every single market event. But let's for once think about what the stock market really is. See, stock market is basically a meeting place where millions of people come together to express their bullish or their bearish views. And what we see as a result is one single price on our screens. So how can we really say why the market goes up or down, not just yesterday, but on any given day? But still, that said, we can probably guess the reason why the markets seem depressed. See, in the short term, the markets move more on sentiments and flows rather than on fundamentals. Starting from last week, the sentiment has been absolutely terrible. Possibly the single biggest factor causing the markets to fall may be what is happening in Japan. I'll give you some quick background. See, the Japanese real estate bubble burst in the 1990s, and along with real estate prices, the Japanese stock market also crashed. In fact, the Japanese stock market took more than 30 years to recover from these losses. The crash also led to a prolonged period of low economic growth and low inflation or deflation. In response, the Bank of Japan started aggressively cutting interest rates. By 1999, the interest rates hit zero, and they stayed near zero and sometimes even negative from 2000 to date. Now, this deflationary burst had a peculiar side effect. It led to the rise of something called carry trades. Now, in simple terms, a carry trade is where a trader borrows money at a low interest rate currency and then invests in a higher yielding asset. For example, you know that Japan has zero interest rates and that the US government bonds yield about 3%. What you can do is borrow in the yen or the funding currency at a low interest rate and invest in US dollar assets like US government bonds, which yield about 3%. The difference is your profit. Now, this sounds simple and attractive, right? Well, yes, as well as no. This trade will do well as long as the Japanese yen depreciates or if Japanese interest rates stay the same or even fall down. But if the yen or the Japanese rates rise, you will make less money or you will even start to lose money. On the flip side though, if the US interest rates or the dollar starts falling, you lose money as well. For a carry trade to be successful, the currency in which you are borrowing or the funding currency should ideally remain stable or depreciate against the currency in which you are investing or the target currency. Now, the Japanese yen has been really weak against the US dollar for many decades now, barring some occasional spikes. Now, this over time has made the yen the favorite borrowing currency for carry trades. Large traders, hedge funds, and other institutions would borrow in the yen and invest in dollar assets like bonds and stocks. Some would even leverage these trades further. Now, the yen was very weak for a large part of this year, but it suddenly started weakening in the run up to the Bank of Japan's meeting on July 31st. In that meeting, the Bank of Japan increased interest rates for the first time in a very long time, and the yen appreciated dramatically after that. Now, if you remember, the yen going up is bad for currency trades. Now, suddenly, all the people who had borrowed money in the yen were making less money on this carry trade, and some even started to lose money. So, they were forced to close trades like going long on US bonds and stocks funded by yen. Now, this puts further pressure on the yen. A rising yen is bad for an export oriented economy like Japan. This negativity, along with deleveraging of Japanese domestic investors, selling by foreign investors in Japanese stocks, and further short positions by investors, is leading to vicious feedback loop. Now, of course, I'm oversimplifying this, but this is largely the gist. The other big factor that is causing turmoil both in Japan and globally is the perceived deterioration of the US economy. See, last week the US released its job data and it was very disappointing. This is causing concerns that the US Federal Reserve might have made a mistake by keeping interest rates high, and this will inevitably lead to a recession in the US. Now, why I'm mentioning this is because there is a very popular saying which says, if the US sneezes, the rest of the world inevitably catches a cold. Now, given that sentiment drives markets in the short run, the Indian markets are not immune to the bad vibes as well. Now, let's move on to the next story. This story will be an extension to the previous Japanese yen story, where I will talk about whether the US Federal Reserve will make an emergency rate cut or not. See, whether the US central bank officials admit it or not, they care what the stock market does. Right now, the US stock market, just like the Japanese market, is not looking great. Early last week, the default expectation was that the Fed would cut rates once by 0.25%. However, given last week's 2% fall and the probability of the market falling even further, the markets are now pricing a 0.5% rate cut in September. Not just that, some believe that the Fed could convene an emergency meeting and start cutting rates much before September too. This is a low probability event, but it is still something to consider. Now, if you remember, in 2018, the Fed had decided to stop hiking rates as the US markets fell. So, whether the Fed admits it or not, it cares what the markets do. But that said, why are the US markets really going down all of a sudden? See, going back to what I previously said, it is impossible to say why the markets go up or down, but we can definitely look at some potential factors. So let me outline a few things that may worry the US markets right now. The US 10-year bond yield is below the 4% mark for the first time since 2023. This is due to the possible selling of bonds by carry traders, the increasing probability of a rate hike, and the bond market pricing in a deteriorating US economy. The US market might be worried that the Fed is late in cutting rates. By keeping rates for longer, the Fed might have all but guaranteed a recession. Now, adding to the previous point, the latest US jobs data shows that the unemployment rate is rising and is currently at a 3-year high. Now, this is not good news for sure. A rising unemployment rate is a sign that underlying economy is very weak. This is confirmed by the fact that the US manufacturing activity is also slowing down. The other concern seems to be a shadow in the earnings in AI-fueled companies like Nvidia, Intel, Amazon, and Microsoft. These companies saw great rallies in the hope that AI would transform everything. However, now it may be the case that the market is re-evaluating these narratives. Then there are also the geopolitical concerns like what is happening in the Middle East between Iran and Israel. But all said and done, no one can really tell you why the US markets are falling. It could be one of these reasons or all of these reasons for all you know. Moving on to the next and the final story for the day, I'll explain why tractor sales are heavily falling in India. See, every month, the FADA or the Federation of Automobile Dealers Association of India releases data to showcase the performance of the Indian automotive market. Now, the automotive space is particularly interesting and exciting because it gives us a very strong sense of the overall economy. Also, with the rise of EVs and CNG vehicles, there is also a lot of investor interest in this area. So I thought, why not talk about some of these interesting automobile related insights from this report in today's story. See, for starters, the overall auto retail sector did fairly well by growing at 13.84% year on year. But if we break things down, the insights become much more interesting. See, the sales of two-wheelers, three-wheelers, passenger vehicles, and commercial vehicles all rose after a relatively silent previous month. But on the other hand, tractors continued to see a big drop in sales. Tractor sales fell by almost 12% year over year after falling as much as 28% year over year last month. This can mainly be attributed to uneven monsoons and even a horrible heat wave that affected agricultural produce across the entire country. For example, the sown area of kharif crops has declined by about 2.4% since July last year, and this is due to climate change. Now, this could be one big reason for a drop in tractor sales. Another reason could be the high sales of tractor last year, which could have resulted in reduced sales this year. To give you some context, tractor sales were up 21% as per FADA's July 2023 report. But apart from tractors, all other segments saw positive growth this time. The largest growth was in the two-wheeler segment, which went up by 17% year on year. Now, this was due to a recovery in India's rural economy and the prospects of an improved monsoon. Now, in case you're wondering why I'm even talking about rural demand, see, data suggests that over 55% of two-wheeler sales in the country come from rural areas. Moving on to talk about EVs, the FADA report shows how the sale of electric two-wheelers has risen but at a steady pace. Ola Electric, which is the market leader in this case, grew from having a 1.58% market share in July 2023 to having a 2.88% market share in July 2024. Ather, on the other hand, grew from 0.54% to 0.7% during the same time period. Now, this slower growth could be due to the expiry of government subsidies on EV vehicles. The government is yet to introduce a new incentive scheme to encourage people to buy EVs. Tata Motors recently announced its results and even mentioned that EV car sales were impacted by the expiry of these subsidies. Now, the FADA report did not really provide any insights on CNG vehicles, but sales here jumped by 38% to 1 million units in the previous FY. This makes it a red hot segment too. Talking about the passenger vehicle segment, the inventory surged to 67 to 72 days and it is valued at approximately 73,000 crore rupees. Now, this means there is a massive amount of capital that is tied up in unsold vehicles. Again, this is due to a combination of factors like heat waves, elections, etc. Now, because of this, there is an increased competition among manufacturers and heavy discounting in this segment. Things, however, should get much better in the coming months because of the festive season. Many people tend to postpone their buying decisions to wait for a more auspicious occasion to buy new vehicles. This will likely impact auto sales positively while also clearing out their inventories to a large extent. That's all the news I have for you today. I hope you found value in this episode. I'll see you tomorrow. Goodbye.